All right. So if you remember in the last class, we had finished off here. We had looked at a chart of Apple because although Apple is not one of your tickers, but the reason we looked at Apple is that it gives you we were discussing what we were discussing in the last session was, I'll just recap here quickly for you guys to get a sense of where we were. So what we were discussing is the stop logic for mean reversion trades. So we were discussing stop logic because we were looking at DP 6.2 as part of our view of a simple trading system. All right, very basic, simple, very basic trading system where we try to solve only these few decision problems. This is 4, 6.2, and 7. And that's why we were looking at these. 4 had already been done. We were looking at 6.2. We looked at the logic of 6.2 initially for momentum. And pretty much the whole of the last session was spent on understanding the stop logic for mean reversion. Okay, so that's what we had discussed in the last class. And so what we said was here, you would, this is a long-term uptrend actually, if you look at the long-term charts. Long-term uptrend. In that, there is a downtrend happening. And so if you were basically a mean reversion trader, and we thought we would just go further in, just to get, 1 month. We're looking at 1 month actually, assuming that your short-term view is 1 month. I'm just trying to make the point. And this is where we said we would look at a mean reversion trader's perspective. And the mean reversion trader would look at this 1 month downtrend and say, well, I don't believe in this downtrend. I think this is going to turn around and go up very soon. And he's got the long-term uptrend also to back him up. So he's waiting. And if you, as a mean reversion trader, you would be entering first with this stop order entry. And then once you do that, your stop would be over here if the market actually turns around from here and doesn't go below this low, right? You would be putting your stop over here. So that's what we discussed essentially. That once you enter as a mean reversion trader, you put your stop at the extreme price of the previous trend. Okay. So from which the new trend is supposed to be developing. So once it goes above this, you go long. You get the signal to go long because the downtrend gets neutralized. Up until here, as of now, there is no neutralization of this downtrend. High, take this as high, high, next high, another high. No neutralization so far. But if this gets taken out, you have a neutralization of the downtrend. And as a mean reversion trader, you get your first signal to go long. And you do that, and then you put your stop over here. So that's what we had discussed. And just recapping quickly what we discussed in the last class. So that brings us to our last decision problem for the minimalistic position, for the minimalistic trading system, simple trading system, where we try to solve only the absolute bare minimum number of decision problems. So we're going to look at that. Now, as you know, this we have already addressed a little bit earlier to give you some kind of a head start in the, this is our, this is actually our table of contents. Right. So we have already discussed this actually. If you see, this is 7.2. Please remember, this is to be stated in general terms. When we talk about position size, we want to state it in general terms as number of units or position size. We don't want to say number of shares. Although we are now in this particular project, we are trading equities, we're trading shares. Therefore, there is a temptation to say number of shares. But since we are learning some general principles which would be applicable across all asset classes, so therefore we should learn to speak in general terms and say number of units. Okay, if we say number of units or we talk about position size, that will be sufficient. That will be a very general expression. Okay, so if you remember, we had already done this. Okay, a little bit. We had already told you the way you would derive position size. what is the right position size for a particular entry and exit. So remember, when you come to this point, when you come to 7, you are already going to assume, you need to make some assumptions about how this one, then this one, 4, 5, and 6.2 have been solved. You need to make some assumptions about how these have been solved before you can solve this, all right? So we already had discussions on how to solve DP4. As far as DP5 is concerned, we have already decided that we will always solve it for the moment. For the moment, we are going to solve it always with a entry at a market price, right? So DP5 is about whether I should enter at the market price or at a price worse than if I'm going long. Should I go long here at the market? Right now, there is no signal. Or should I go long at a price less favorable than the market with a stop order? Or should I go long at a price below the market? I'm more favorable than the market with a limit order. Okay? And this particular problem, we had said we are always going to, initially we are assuming for the purposes of our simple trading system, we are going to assume this simple trading system initially that we are doing, we are going to assume that all entries are at current market prices. So that DP5 gets automatically solved by like that, okay? Now we also need to make an assumption about DP 6.2, okay, which we have already learned how we are going to do. So the way you come to this buy-sell decision problem situation, the way you come to this particular DP is this is how you do it, okay? So let's take let's go back to one of your project tickers. Let's look at FCX, okay? And what has happened here, yeah, I think your FCX, actually there is a neutralization of the uptrend here. All right, you can see this last, so there is some kind of material information here, and right, so you can see this last trend that's been broken actually. So the uptrend has been broken. So let's try and see if there's any other ticker where we have, let's look at your project tickers. Let's look at something where there might be, let's look at, okay, so let's, this is down. Okay, this is pretty much down, although there's a slight neutralization of this. We will pretend that this neutralization here has not happened. And this seems like a pretty strong downtrend. If we look at a little bit longer also, it's a pretty strong downtrend. So we'll go with the downtrend view. We'll assume that the one-year trend is down. We'll just ignore the slight break of this neutralization. So the one-year trend is down. The 3-month trend is also down, okay? So let's say as a momentum trader, now we're trying to see how we are going to solve this position size. Okay, we've already done it, but I'm just showing you that before you come to position size, right? What happens is before you come to position size, you have to already solve some of the earlier decision problems. And we look at, so we are solving DP4 initially. We look at 1 year, we see a downtrend. We look at 3 months. This is our short-term system. We see another downtrend. And we assume here that we are a momentum trader. For the purposes of this example, we will assume that we are a momentum trader to see how the DP7 is being solved. Okay, so we enter as a momentum trader. So we enter at say 23.5. Okay, we go short at market. Okay, since both the trends are down, we want to go short as a momentum trader. And let's say the market entry is 23.5. And of course, our stop will have to be here on the break of this high. So let's say it's 26. Okay, let's call it 26. All right. So we take the market entry price, we take the market exit price, and if we take 23.5, and so what we do is we look at the exit price with the loss. We put that, let's say we put that as 26. And we put the entry price as 23.5, okay? So So when we are going short, we are going short 23.5. That's our entry price. And so the entry price is 23.5. The exit price with loss is 26. Where do we get those figures from? Basically here. Just try to get this done. Yeah. So in the simple trading system, we have made some assumptions about this. We just made an assumption about DP4. We're going to have a sell bias in this example of Wells Fargo. Exit price with loss. Okay, entry price, we have to make a decision. We are already going to make that decision about going short at market, which we did. We made the decision about the exit price. So we entered that information, right? And we see that the P&L per unit is 2.5. Okay, and now we have to bring in the information about the maximum risk per trade, right? And that information comes in from this sequence of events, this sequence of steps, where first we take our investable capital, okay, which is what we have. This is an exogenous input. Okay, you have what you have, right? And this is there. And then you have to figure out for yourself what percentage of that figure of the investable capital, what percentage of that investable capital is risk capital for you. That is, what percentage of that money are you willing to lose as a normal business loss. So that in this case, I've given these cyan cells a user input. So if you want, you can change it. You can make it 75%. All right. So if you have 75%, that means your risk capital is 750,000. Okay. And then you have to make an assumption. So remember, these are all for a particular period. Okay. These are for a particular period. All these figures, investable capital, risk capital, the projected number of trades, these are all relating to some period. So you're looking at some future period. Maybe you're doing your planning for 1 year, or 1 quarter, or for 6 months, any given period. Okay, so you have to project the number of trades you're likely to do in that period. And typically the way you do it is you look at the number of days, number of trades you're likely to do in a day into the number of trading days in the period. All right. So you make that projection. Okay, these are all projections, so they may not be exactly correct, but at least these numbers you know. Okay, investable capital is under your control. Risk capital is undecided by you by fixing this percentage. This projected number of trades, it may not happen, but you can still control it. At least you can keep it at the maximum. Okay, if you do 3 trades in a day and that's what you have planned, then you can make sure you don't do any more trades. So you can control the maximum value for this figure, but the minimum value you may not be able to control because you can't predict how many signals you're going to get. So this is a projection, and then percentage losers is also a projection. This is your estimate as to how many trades you are going to lose money on. So 70%, and then you have your number of losing trades. So the way you come up with the maximum risk per trade is to ensure that you do not lose more money than your risk capital, budgeted risk capital. This is the most important principle, in trading. If you can, this is the most important thing to look out for, which many professional traders, also even professional traders, fail to do. That's why many funds and traders go bankrupt, because they fail to exercise this important type of control. That losing money is not a problem, but losing more money than you had budgeted to lose, that is a problem. Okay, you need to be able to control your losses, and this is where your basic trading survival comes in. Okay, this is the most important aspect of trading. Defense, basically, essentially ensuring that you do not lose more than the amount of risk capital you have set aside for that period. Okay, so everybody now understands how we got to the maximum risk per trade. Okay, So what you see here, what I'm trying to lay out is that and so the way we do it is that we have the maximum risk per trade, and we know how many units we are losing. Okay, we have not factored in the brokerage over here. Please make sure that when you're doing the calculation, you factor in the round turn brokerage. Here we have some brokerage calculations. Okay, we have put some of that in. This is already in a formula. Make sure you have that in your formula, but for the purposes of the example, I'm not discussing that. All right. So the way you do it is this one. Okay, let's put a. So for the derived cells, which are formula outputs, I'm just putting this color here. All right. So what happens here is that you are entering. This obviously would be, if you're entering at 23.5, this would be much lower, like 18 or something like that. All right. So exit minus entry. Exit minus entry. Okay, because this will actually end up being plus, because we'll enter once we enter the position size, that will be in with a minus sign, so it will still end up being positive. So because this is a profit projection, actually, this also can be put here like this. Okay, so the way we figure out the maximum position size, we are discussing that right now. How do we figure that out? Okay, so the way we figure it out is basically going through all these calculations: investable capital, risk capital, number of trades, number of losers, and then divide the risk capital. Okay, so you can see this. You divide the risk capital by the projected number of losing trades. So what we are assuming here is the number of losing trades that you have. Okay, if you have, let's say you have these losses like that. If you have all the losses together, and all the trades that you're doing in this manner, you keep having the losses, all right? So the first 88 trades in the system will all be losses. And this is the worst case scenario. So this is a very, very conservative way of planning your losses and planning your maximum risk per trade. Because if your estimate about the number of losers is correct, okay, and as I said, this projected number of trades, you can control the maximum value. You can't control the minimum, but you can control the maximum value. So that is the more important part actually in this calculation. So you can control that. You can't control this because this is just an estimate, okay? Which is why it's always a good idea to have a very high estimate, okay? So therefore you make sure that, because on this number, you don't know what the actual number is going to be, percentage losers. But if you estimate that you'll have 70% losers and you actually end up having 55, then you're okay, because you have budgeted less risk per trade. Okay, if you have 50%, okay, you will have less risk per trade than if you budget 55. Sorry. Watch what happens to the 8.5K. 8.5 goes to almost 11K, right? So if you assume that you're going to have 55% losers, and then based on that assumption, you start betting about 11K per trade, but actually it turns out when you start trading and you look at things that are actually unfolding, it turns out that your actual loss rate is 74%. Then you will run out of your risk capital very quickly. So basically what will happen is you will bust this requirement. You will lose more money in case all the losses are stacked up together, right? If they're all stacked up together like this, and so on and so forth. In this manner, if you see, one after the other, the trades are happening. I'm not going to draw, 93 losing trades in a row. I'm not going to put in 93 L's, but this is what you imagine, okay? Keeps on going in this manner. So if you make an assumption which is very aggressive about the percentage losers, that is, I assume 55%, and therefore I was betting about 11K per trade. But actually what happens is, so I was only budgeting for 69 trades. But what happens is that I actually end up having a loss rate of 74%. So 93 trades. So by the time I get to my 70th trade in this manner, as the losses keep piling up, every trade is a loss, one after the other. And by the time I get to my 70th trade, I have already busted my risk capital amount because this is not changing. Okay? So what is very important here is that this should be taken as a very conservative figure. Conservative figure in this case means a very high figure. That's what conservative figure means here. Okay. So if you budget for 74%, then you'll be risking only 8K per trade. And you can act, and if it turns out that your actual percentage losses is much lower, then you're okay, because all that you have done is you have been betting less money per trade. Okay, which is fine, which is not which is not a problem actually. Okay, so therefore in this business, there is a certain asymmetric dynamic here, that if you lose, if you make less money than you thought you would make, or if you make less money, you make 14% instead of making 25%, that's not a big deal actually. You can still survive, all right? It's not a big deal. But if you had planned, if you had only risk capital of 750K and you end up losing 1.4 million, now that's a problem, okay? So therefore, it's an asymmetric dynamic going on here. Asymmetric means that it's not equal on both sides. On the profit side, if you make a little less money, that's not a big deal, but you can't afford to lose more than this amount for any given trading period. So if you estimate a very high percentage of losers and you actually lose less in terms of percentage, that's fine. You can live with that. It only means that you were trading, you were not trading so aggressively, which is fine, not a big deal, right? So this logic so far, I hope everybody's clear about what we have discussed. We've already done this before. I'm just recapping that, because we are discussing now the last decision problem in our simple trading system, which is DP7, how to figure out the position size. But we are going to come up with some more general principles here, okay? So now let's look at this, okay? Now we're going to talk a little bit in terms of algebra, okay? So we want to understand this because we'll have to do some formulae and things like that. So this is, I have referred you to this cell number B30. I hope it's B30 here. Yeah, that's where we are. If I put in some more cells somewhere, if I insert some, this may change, but you know where we are talking, which part we are talking about, where we had this calculation, all right? And so therefore you come up with the position size after including the brokerage, okay? In the brokerage has to be factored into the maximum risk per trade. So when we say you can't lose more than 8.1K, that is not just the entry minus exit price, exit minus entry price, but also even the brokerage that you're always going to lose. The brokerage, round-term brokerage is always a loss, even on a winning trade. So that must be factored in. And initially when you're planning, you're looking at the loss side of the trade. So you're assuming that every trade is going to be a loss. And that's how you plan your position size. So you look at the maximum risk per trade, and the brokerage has to be included as part of this, and any other transaction costs, etc. Okay, so what we are saying is that we are trying to look at this in a very slightly mathematical way. Try to look at it and write it like this. Okay, so what we are saying is, what is the number of units? When, how do you decide the number of units? Let's look at this. So what is the algorithm? Okay, so let's say algorithm is called algo. Okay, what is the algorithm? It's basically a set of steps. Okay, algorithm is basically a set of instructions or steps. call it actions. Here it has to be objective actually, because in terms of algorithms, we discuss always in terms of computer programs. A set of objectives, actions, or steps. Okay. Or in fact, instead of set, let's make it better. We make it a slightly more meaningful term. A sequence of objective. By objective, I mean, what I mean by objective is that it should be understood in the same manner by everybody, which means if I'm leaving the room and I'm giving an instruction saying that if the AC, if it gets very cold, then switch off the AC. That's not an objective instruction, because very cold is different for different people. But if I say that if the temperature, you have a thermometer, let's say in the room, which is showing you the temperature on a screen, the room temperature. And if I tell you that if the room temperature falls below 15 Celsius, then switch off the AC. Now that's an objective instruction, because 15 Celsius will be understood in the same way by everybody. So that's what I mean by objective, because we are talking about algorithms in the sense of a computer, in the sense of computer programming. So we want to understand this term. Algorithm, often referred to in the markets as algo. Okay, so algo is just a short form for algorithm. And what is an algorithm? It's a big word, but it's nothing but a sequence of objective actions or steps. Okay. Okay, so in the sense of computer programming, as I've told you guys, everybody should try to develop some understanding of programming, especially as a finance student. And when you do that, please make sure you're developing classical understanding of the subject. Don't just do superficial courses. Try to do a basic computer programming course from MIT or Berkeley or Caltech or one of these top engineering schools. So start with the basic computer science, basic programming course, and try to understand it from a fundamental point of view. Okay, so algorithms, so these are some of the terms you will learn if you do programming. So a sequence of objective actions or steps, okay, completing which achieves some task. Okay, so you can have an algorithm for making coffee. If you're designing a robot for making coffee, you can have an algorithm for making coffee, which will have like, open the kettle, pour the water, switch on the kettle, then wash the cups. These are all going to be steps. Wash the cups, put the coffee powder in, and so on and so forth. And so once you complete those steps, you will have a completed cup of coffee. So that's what algorithm is. So we are just trying to figure out what the algorithm is for, we're trying to figure out the algorithm for the determination of the position size, okay? So here we're trying to first understand the algorithm. We've already explained to you what the algorithm is. We already had that discussion as to how you arrive at the position size, okay? And then you take the maximum risk per trade. You look at the loss per trade, also factor in the brokerage, and then you adjust the maximum risk per trade. You adjust the position size. You keep on doing what we had discussed initially is a trial and error approach, where you keep on doing this trial and error, and you try to make sure that your total loss is less than the amount that you are allowed to, is actually ideally equal to the maximum risk per trade, but certainly less than this. So 8.1. So here it's coming out to 8.5. That's not good enough. So you would have to essentially reduce this. Now that you could maybe do 3300 or something like that. And this is also a little bit, so 3250, which you can't actually do. Okay, so which means if you do 3200, because you have to trade in this particular situation where you're trading US equities, the unit, the lot size is 100 shares. So you trade in multiples, integer multiples of 100 shares. So therefore you end up with a share, in this case, the position size of 3.2. So we did it by iteration, actually, by doing trial and error. And now we try to formalize this as using a little bit of algebra. Okay, very simple. So what we are saying is, what is first, we are defining it as the position size is a function of what? Position size, as you can see, is a function of, it looks at the maximum risk per trade, and it looks at the entry price and the exit price. So that's what we are writing here. Okay, that the position size is, you guys are familiar with this notification, with this kind of notation from mathematics, that y is equal to f of x, okay, and here it's actually f of x1, x2, x3, etc. So position size is the function of the maximum risk per trade. We should put semicolons. Exit price on loss and entry price. Okay, P is for price, and so in fact we will write it as EXP and ENP. Save us some time. Okay. Right. So exit price on loss and entry price. So this is how position size is determined. Position size is a function of this. Then okay, so this is determined by your DP4. This is determined by the DP4 algorithms. Okay, this is determined by the 6.2 decision problem rules. Okay, I'm just trying to see. All right, so exit price comes from, so we said initially that position size, which is what we are trying to solve here, which is DP7, that is a function of max risk per trade, exit price on loss, and entry price. So exit price on loss is determined by the rules we gave you in this discussion of 6.2, which is your previous session, last two sessions prior to this one. Then entry price is decided by actually two things. It's decided by the buy-sell bias. That comes later actually, and it is also decided by the rules of DP5, which we are always solving in terms of, at this particular point of time, we have assumed that all entries are going to be at market prices. So there is an automatic solution to DP5. It's not really a decision problem anymore because the solution is always the same. There's no confusion. So entry price, so what we are doing, all we are doing here is initially we are saying position size is a function of 1, 2, and 3 variables. Okay, so how do we arrive at those variables? Exit price on loss comes from the logic of 6.2, the 6.2 discussion. Entry price comes from the logic of DP4, which gives you the buy or sell bias, and the DP5, which gives you the entry price. Okay. So here you have these two. And then the maximum risk per trade, that comes from, okay, now what we can do is, this is a function of these three. Now we understand these three, try to understand these three a little better. And position size is a function of, one of those is maximum risk per trade. So now we ask ourselves that what is maximum risk per trade a function of? As we saw here, maximum risk per trade comes out of investable capital, risk capital, projected. So what we'll do is, before I copy this down, I want to make the font size really small so that we don't have, this is 14. I'm going to make this 14 so I can copy it without having any problems. Okay. So it is a function of, let me call this, that's okay, let's write it initially like this. So this is a function of investable capital, okay, the function of risk capital percentage. So investable capital and risk capital is a function yeah. Another way to do this is you, instead of writing these two, I'm writing these two because I want to get down to the atomic level disaggregation. Okay, what is a function of what? Another way, understand that another way to do this is to look at both of these. If you take the investable capital figure and you multiply that with the by the risk capital percentage, that is what percentage this particular figure is the answer to the question of, this figure here is the answer to the question of what percentage of my investable capital am I willing to lose in this trading period, whatever it is, 1 year, 1 quarter, 1 month, whatever that period is. In this period, what percentage of my investable capital am I willing to lose as a normal business and still treat it as a normal business loss? Okay? Which means it will not stop me from continuing to trade in the next period. That's when you ask this question, this is the answer to that question. Okay, so when you take this and you take the risk capital percentage, what the output that you get is the risk capital. Okay, so the other way to write this is to write, instead of these two, you can just write the risk capital amount. But then you will have to again write another line saying that risk capital is equal to investable capital, is a function of investable capital and risk capital percentage. Okay. Everybody follows here. So instead of doing this, I'm just doing everything. I'm writing all the atomic level formulae right here. So maximum risk per trade is a function of investable capital, risk capital percentage, which gives you the risk capital amount. Okay, and it is also a function of projected number of trade. It's a function of projected number of trades and percentage losers. All right. Okay. So now you see, once you have these 4 variables, investable capital, risk capital percentage, this gives you the risk capital figure, projected number of trades, and percentage losers. Once you have projected number of trades and percentage losers, you have maximum number of losing trades. Okay. I should write this a little better. Projected number of trade and percentage losers. Okay. Say, we will not write it as maximum number, we will write it as number of losing trades. Okay, so once you have projected number of trades and percentage losers, the combination of these two, okay, this percentage into this number of trades gives you the total number of losing trades projected. Okay, and once you have this figure, so with these 4 items, you can essentially come up with the maximum risk per trade. Okay, which is basically your risk capital amount divided by the number of losing trades. Okay. I hope everybody has understood why the maximum risk per trade, this is an important thing to understand here. Why is the maximum risk per trade derived in this manner? Because the logic is that this is a kind of a very worst case kind of scenario planning. You have other ways of doing it, but I'm giving you one very, very conservative approach to planning your risk capital, because with this kind of conservative planning, it will be very difficult for you to go bankrupt. So I'm trying to protect you. I'm giving you a very conservative approach, and you can use this as an extreme kind of benchmark. Okay, so therefore, this is a kind of extreme kind of benchmark, and then you can decide eventually when you get comfortable with your own trading style. You establish your own trading style when you're very confident. You can maybe deviate from this a little bit, but I think on risk planning, this is not a bad approach, because this is eventually, this will make sure that this will keep you alive in the markets. Okay, it will protect you. So these kinds of steps are very important. Okay, so this is an extreme, but it's also important to understand that there are other ways to do the risk planning, right? But this dynamic will always remain. That maximum risk per trade will be a function of these 4 variables. It's just that in other types of uh, in other types of, and I'm making an assumption here. Okay, so I made an assumption about the highly conservative approach to risk planning. Okay, so in our example, okay, so what we're doing is,
Sir, this is more like an upper limit to our losses, no?
correct. So it's basically, if your assumptions about these figures are correct, okay, the assumption, obviously the reason I'm dividing it to figure out the maximum risk per trade, the logic, first make sure that everybody understands that. The logic for deriving maximum risk per trade by dividing the risk capital amount by the total number of losing trades. Okay, that the logic obviously is that if we assume that even if the worst thing that can happen is, let's say our projections are correct, that means we are going to have 93 losing trades in this trading period, say 1 year. We're going to have 93 losing trades, and we assume that all 93 losing trades will happen right at the beginning. Okay, so when you do your trades, a total number of trades is 125, out of which losing trades is 93, and we assume that every time you do a trade, the first 93 trades are all losses like this. Okay, all losses lined up like this, one after the other. So obviously, if your assumptions here are correct, now the loss distribution can't get worse than this, right? This is what I think Utsav was saying, right? That this is what the idea is, that obviously the loss distribution can't get worse than this, because you're assuming that all your losing trades are happening at the very beginning, all one after the other. Okay, first number of trades, losing trades is all stacked together. So it can't get worse than this. So this is the worst case scenario. You can call it maximally conservative approach to risk. We will use some layman's terminology. Worst case scenario, that is basically what I'm talking about. Okay. So, so we assume that all projected losing trades occur okay. So that's basically what we assume. Okay, and then so the way we set up this number, if we set up this number like this, that means even if all the trades together happen like this, I still don't lose. I lose only 750,000, not more than that. So this is important, because this is a very important point, that you should not lose in any period. You should never lose more money than the amount of money you have put aside for losses for that period. Business loss budget. Every time you have a budget that this month, next quarter, I'm going to spend so many rupees on electricity. If you're running a business or a plant, then you should not spend more than that on electricity, unless you have more production than you planned, etc. So anyway, so this is basically how we come up with it. Okay, so what we are saying is that maximum risk per trade is a function of these four variables. Okay, investor. So what happens is, now we have done this as a maximally conservative approach to risk. Okay. Now what happens so this dynamic will never change. Okay, there are other approaches to risk. Okay, which is, and this is what we call, I'll explain this term later. This is a kind of a okay, let's not use that term here. Okay, so other risk planning. Okay, so the reason we do worst case is basically we want to make sure that there are no negative surprises. So if I'm already prepared for the worst case, then I can never get a negative surprise. Okay, So that's basically the idea here. One of the most important things in trading is to be able to avoid a negative surprise. When I enter into the next period, when I plan out my trades for next year, I am already mentally prepared to lose $750,000 next year trading, and I'm okay with it. That's why I put these figures up. Okay, so if I lose maybe 400,000, that's fine because I was ready to lose 750,000. So losses should always be less than budgeted losses. And this is very important, and that's why we have this maximally conservative approach to risk planning. Okay, this kind of scenario. Other ways to sort of project, you know, uh, the distribution of losing trades. I'm just giving you some information here. We're not going to go into that. Okay, there's something called the Kelly formula. But what it does, I'll just tell you what it does. As you notice here, let's make this, you don't have to have it in bold. Okay. As you notice here, we can maybe, let's keep it stacked together. It's easier to see everything. Okay. So as you notice, maximum risk trade is a function of these four things. So this mathematical reality does not change. Okay. The only difference is that the method that I'm teaching you, which is the maximally conservative approach to risk planning, okay, worst case scenario based planning. Now, that is one approach, which is the maximum very conservative approach, but you can have more aggressive ways, okay? Let's put it this way. Other more aggressive. Aggressive here means not that you're going to beat people up, but aggressive means that you are more aggressive relative. So conservative is a conservative approach, and opposite of that is aggressive approach. More aggressive ways, other more aggressive ways to project the distribution of losing trades is one example is a Kelly formula. You can look at that. But that essentially what it does, okay, involve probabilistic modeling. I'm just telling you essentially what it does. We will not discuss it in detail, but if you encounter things like this, or if you're curious, you want to go and see this, although I think this is not a very good approach, I would always guide you towards this approach. But you should know about this, okay, because this is more popular in industry, so you should know about this. But for when you actually do your trading, I always prefer this because this is guaranteed to protect you. This is much more likely to protect you than this one. So Kelly formula involve essentially probabilistic modeling of basically, probabilistic modeling of distribution of losing trades. Just writing it once again. Not really required, it's redundant, but this is basically what it means, okay? So what they do is, in terms of the actual approach to the modeling of this this percentage losers, here the important part here is actually, because if you see here, there's not, here there is a projection risk involved, forecasting risk, because you are projecting your losing trades to be number of 74%. But in fact, nobody really knows what the number is going to be, okay? As I said, on this number, you have a lot more control, okay? You can cap this number easily. If I have projected 125 trades, I can ensure that it doesn't go above this, but I can't really control this one, okay? Percentage losers, I can't control. And of course, I also can't control how this is distributed. Therefore, I assume that is the worst distribution possible. All the losses stacked up together from the very beginning. So therefore, by doing this assumption, I am actually removing the negative surprise risk of any kind of forecast going wrong. Okay? But I can't predict this. Okay, so what it does basically, in the other approaches, Kelly formula, etc., they assume that this loss distribution, okay, you're familiar with probability distributions, okay, they make some assumptions about how these losses are distributed, and they make some assumptions about the number of losses that you're going to have, etc. From that comes from your trading system, actually, the historical estimates from your trading system. And so essentially the idea is to do probabilistic modeling. Okay, what I've done here is a kind of a worst case scenario, just slightly different, which is much more crude. And probabilistic modeling looks more sophisticated. But the problem is here that here you have a high risk that your estimates may not be correct. Okay, your estimates may be too aggressive, that you may assume that you will only have maximum of 3 losses in a row. Okay, and after that you will have profits. When you do probabilistic modeling, you may make those kind of assumptions. Okay, uh, probabilistic modeling uh, of the distribution of losing trades. Okay, another term that you can look at, okay, here, which is a technical term from statistics, which we are not going to go into right now, because right now my focus is on making sure we get the practical aspects sorted out to help you do your project and the loss planning. So there is a term that you can look up later and learn if you want. I don't think there's any huge amount of useful insight that you can get from it, but you should know about these terms. That when you do something like this, when you do probabilistic modeling, what you're essentially doing is 2 things. You're trying to project the number of losers and from the trading system, and you're trying to project how the losses will stack up. Is it going to be this all this sequence of losses in a row, or is it going to be more like uh, 3 losses? Is it going to be this is like this, or is it going to be like 2 wins, 3 wins, 4 wins, 5 wins, and then again 2 losses, okay, and then again a win, like this. So this is basically this is what we are trying to figure out. Basically, we're trying to project how these things will come, okay? Because essentially what happens is if I do have 3 losses in a row, this is eating into my risk capital. It's eating into my risk capital. But the moment I have some winning trades, then I make back some money. Okay, so this capital amount comes back. Okay, so I can play more aggressively. So this is in real life also some kind of such distribution will happen. Okay, when you actually trade, some such distribution will happen. But the problem, of course, is that when we are forecasting for the future, we don't know what will actually turn out. We don't know what kind of pattern is going to eventually evolve. Okay, so now essentially this, so there is a branch of statistics which deals with this kind of. So this is actually quite your head will start spinning if you start thinking about all the possible scenarios, especially if you have a very large number of trades. If you start thinking about all the possible scenarios, how many types of scenarios can happen, your head is going to start spinning, okay? So usually people do some kind of a probabilistic modeling by using Monte Carlo or some other kind of some probabilistic modeling method, okay? So what you try to do is you do some probabilistic modeling for this, but understand that with all kinds of probabilistic modeling, there is no guarantee that this will be correct. The answer will be correct because you may end up being too aggressive. Okay, so you may end up being too aggressive. So that is always a risk. Okay, so in the sense of I can do probabilistic modeling and I can figure out that I can make an estimate that maybe I will live to 95, to the age of 95. This is not a very good example, but I'm just giving an example. But then in probabilistic modeling, there is a very high risk that I actually may not live till 95. So that kind of risk you don't want to take ideally in trading, but I'm just teaching you a little bit, I'm just giving you a little bit of background in case you encounter this kind of a squeeze. Okay, like somebody is not on mute. Srishti is not on mute. So, okay. So, all right. So that's what we had. I just want to teach you a few terms. That this is a conservative approach and the worst case approach, and then this term called probabilistic modeling, and there's this term called the Kelly formula. If you learn about the Kelly, if you come across these terms, and there's the theory. There's in statistical, in stats, there is a branch of stats called the theory of runs. Now, what is a run? And the theory of runs essentially deals with this kind of modeling. That here, what you say is, here we have a run of 3. So this is what a run means. Okay, run not in cricket as in scoring runs, but essentially similar idea, I guess, somewhat. So here we say we have a run of 3 losses. Okay, we have a run of 1, 2, 3, 4, 5. We have a run of 5 winners. Then we have a run of 2 losers. Okay, so that's basically what runs means. Okay, so what they do essentially is that using some kind of probabilistic modeling, using some assumptions about the probability distribution of the losing trades, and they're applying principles from the branch of statistics that deals with the theory of runs. You have things like the Kelly formula, etc., which will essentially figure out. All they're doing is, it's a very mathematically sophisticated way, much more sophisticated than what we have done here. It's a mathematically sophisticated way to basically project this, and taking inputs from your trading system to project the risk capital percentage, the percentage losers and the distribution of losing trades. Okay. And based on that, they are still doing the same using the basic model that the maximum risk of the trade is a function of these things. And then they come out with the maximum risk per trade and eventually the position size. Okay. So once you know the maximum risk per trade, and you know this one, and you know this one, entry and exit prices, then you can figure out your position size. So all this stuff like Kelly formula, etc., these are actually meant to solve the problem of position size, which is your DP7, which is what you're doing right now. Okay, so Kelly formula, etc., comes into play when discussing position size. But as you saw that, as you can see here in this formulation, when you want to arrive at position size, actually what is important is the maximum risk per trade and estimate, and these two. And estimating this involves certain assumptions about how many losing trades are going to happen and how are they going to be distributed in terms of their runs. So that's basically what you're doing. So this dynamic does not change. That maximum risk per trade is always a function of investable capital, risk capital, projected number of trades, and the percentage losers. All right. So that's basically the point here. Any questions at this point? No questions, then we'll go on to the next. Now we have to get into, we'll have to see how much reading people have done. Because we have to now, what we're trying to do now is, this we've already done, a discussion of investable capital, risk capital. Yeah. So pyramiding here we'll treat as a more advanced topic, which we have already discussed earlier. We won't get it. Now we have to, what we have to do is this part. Okay, we are going to now make some changes here. So what we did was, earlier when we solved this problem of position size, we looked at our figure for maximum risk per trade, and we looked at the PNL per unit, projected PNL per unit, and loss per unit specifically. And then we kept on iteratively doing trial and error and figuring out what is the number of trades where we ensure that our loss is actually equal to or less than equal to the maximum risk per trade. As close as possible to this, but just equal to or less than. Okay. So that's what we did by doing trial and error. Now we don't want to do trial and error. We want to make this an algebraic formulation, and that's what we're learning right now. Okay. So Yeah, so we are going to model the trade P&L. Okay, and we're going to learn some principles about modeling the trade P&L. Okay, so as you can see here, once again we are writing the trade P&L, which is here. We saw that the trade P&L, we are forecasting the trade P&L. So trade P&L is a function of, let's ask double A. Trade P&L will be a function of what?
Hello.
Trade P&L will be a function of which variables? Here we have trade P&L. This is a function of which variables? I'm making it easy for you.
Sir, it's entry price
Yes.
and the price at we will exit.
Okay. Exit price or not. So especially, in fact, instead of trade P&L, we can talk about trade. Although we are writing it in general terms as trade P&L, but right now we are focused more on the exit price with loss. So it's a trade loss basically, modeling the loss per trade. Okay. But
Yes, sir.
you have missed out one more factor, which is this.
Brokerage.
What is the other one?
So we will consider brokerage also.
Brokerage, fine. For the moment, we assume that we don't have to worry about brokerage. Okay, in this kind of calculation, we don't worry about brokerage. Okay, but another thing that you have forgotten is that
Profit, if we exit with profit.
no, not profit. The other thing, obvious thing which you have not mentioned is position size, because
Yeah.
here we've done it
Yes, sir.
specifically for one unit, but
Yes, sir. Yes, sir.
you have to understand this, that this when we write
Multiply by units also. Total.
multiplied by the number of units.
Yes, sir.
Yes, it's actually, so conceptually what we have to visualize here is that this is actually exit minus entry in brackets times 1. Okay,
Yes, sir.
so 1 is the position size because we have done this calculation for, right? So that is what we have to understand. Okay, good. So so this is a function of let's see if we can copy something from here and avoid having to write. Yeah, let's try and copy this, and then I can just avoid writing. So I'm writing the trade P&L, okay, or trade loss. We'll write P&L, but we'll think of it as a loss. Okay, is a function of position size. Then it is a function of position size, exit price on loss, and in fact, so let's write as trade loss. So trade loss, okay, is a function of position size. There's some background noise. Okay, so you have position size here. The trade loss is a function of position size. It's a function of exit price on loss. It's a function of entry price. Okay, so this is the general form of the function. Okay, so then we specify the function, and what do we write? Let's try and get this from. Okay, so we'll write it as so I'm just trying to copy it from somewhere where I have written it down. Okay, so let's look at it this way. So that I don't have to write it down once again. Okay, so we write this as trade loss. We'll write it as P&L. Okay, and write the P&L. going to use short expression because we're more formulating stuff. Okay, so just PNL projection. We're just trying to algebraically write it down. So PNL is equal to position times exit price minus entry price. Okay, just make sure you understand this very clear. It's very basic, but if you ever forget it, so everything kind of flows from here. But in case you ever get confused, if you can just think about any example where you just go to the market, or if you're, let's say, a wholesale dealer in the market and you trade in, say, 100 quintals of sugar, and you buy 100 quintals of sugar at, say, 40 rupees a quintal, and then you sell it at, say, 85 rupees a quintal, and then you figure out how much money you make per on the total trade. The way you would figure it out, obviously, is by position size into exit minus entry, and that's how you get. So eventually, all the trades are everything else flows from this basic concept. But you have to be certain in certain situations, you will have to be a little more careful because there is a lot of detail involved. So we'll see how that happens. Okay, we'll look at the currency markets, and so obviously, if we have this, and remember, we are actually trying to model DP7 as number of units, position size. Okay, so we say position size is equal to this. We can change it around and write it as, so EXP and ENP is like this. Okay, so we can write it like this. Okay, so we write or. Okay, so we write, this is obvious to everybody. Okay, EXP is exit price, and here we assume it as exit price on loss. Okay, but this formula will apply for profits as well. But at this point, we are more concerned with position size modeling, which for that we focus on the loss. This is your anticipatory plan, what we call ex ante position size modeling. So before the trade, ex ante means before the trade. So this is fine. So we have position is equal to PNL divided by exit minus entry. Okay, so this is what we have. Okay, so now this basically happens where you have. Now let's look at the currency markets a little bit, and let's try to understand some of our earlier notes. Everybody understands. If we look at our master list of notes, where we have to, I hope everybody has done this, because this is all, but I'm not going to handhold you through all these notes and videos. You're supposed to do it yourself, and if you have a question, you're supposed to ask me. This basic knowledge is assumed, okay? So transactions as contracts to exchange assets, base asset and terms asset. Everybody, now what we are going to do is this, when we are just making sure we understand all the formulae, and then we can write it algebraically to, instead of having to do this by trial and error, we will write algebraic formulae. But we want to be doing this for the currency markets because that will give us all the possible scenarios that may come up, and it will take care of all kinds of complications. So once you are able to do this for the currency markets, you can do this for any market. Okay. So now we are going to change asset class, although we are doing equities. But since we are learning the theory at this point, the theory of modeling the position size, how do you come up with the answer for what should be my position size? Since we are learning the theory, we want to learn in general principles, okay? So we are going to do it in terms of 3 scenarios, okay? And this is what we are going to follow. Let's do it. Let's write it here. I'm going to write this here. You will have 3 scenarios. Okay. So send one. These are 3 scenarios that we will consider. Okay, and I'm just writing it here. Okay. Focus on currencies. Or let's write it currency markets. Okay. So currency markets, all the currency markets that exist in the asset class called currencies. Okay, so because the currency markets give us the most complex scenarios, we are going to focus on the currency markets first. Okay, that's what we are doing, and then we can apply those principles for every kind of situation. All right. Okay. So in currencies, make sure that we understand something which is base asset and terms asset. Okay. So let's go back to this note. Okay. Here, transactions as contracts to exchange assets. I am focusing you on these two terms. We have to make sure that we always understand what is a base asset and what is a terms asset. So if you look at here, if you look at, let's go to currency markets now. Our first example is actually Aussie US. Okay, so we just call it, that's called Aussie in the currency markets, that's called Aussie. All right. Now, as you can see, I hope you guys can see the scale over here. Okay. Now, let's just test the understanding of base asset and terms asset, and we see how well people have done the readings. Okay, let's ask Raghav. Raghav, in the Aussie US currency market, which is the base asset? Yes, Raghav is sleeping. Okay, let's see who else is sleeping. Okay, let's ask Rashi. What happened? Rashi is also sleeping. Okay, who else? Okay, let's ask Gagan. What happened to Gagan?
Yes, sir. Yes, sir.
Okay, is my question clear? That
No, sir.
in terms of when we look at the Aussie US currency market, normally refer to just as Aussie, one Aussie. So in the Aussie here, which is the base asset and which is the terms asset? I hope you can read the. I don't know if you can see the scale on the right hand side. The scale. I don't know if you.
Yes, sir, it is visible.
Yeah. Okay. So yes, Raghav, which is the sorry, Gagan. Gagan is answering now. So which is the base asset in Aussie? Okay, you're not clear. Who should we ask? Okay, let's ask Bhavya. Can you tell us the answer to this question? Which is the base asset here? No, Bhavya is also sleeping. Okay, some participants have raised their hands. Okay, who has raised their hands? Mukul has raised his hand and Utsav. Okay. Okay, let's start with Mukul. Okay, let's take Mukul. Yes, Mukul.
Yes, sir. So the base asset is US dollar.
Okay, your answer is base asset is US dollar. What about Utsav?
Yes, sir, same. The base asset is US dollar here because the Australian dollar is trading against the US dollar. That is why it is the base.
And they are considering the ratio here.
Yes, sir.
Yeah.
Australian over US dollar.
Okay, 1 minute. What does this mean? Here the ratio, let's look at this. At this point it was 75, what is it? It's very small actually. This is 73.50. At this
Yes.
point, 73.50. So what is this? Of course, it is 0.7350, but we just call it 73.50. Now, at 73.50, what does that mean? 0.7350, what does that mean? One.
So it means 1 US dollar is equals to 0.735 of Australian dollar.
No, sir, that is the opposite.
Yeah, so in this case, Utsav is correct. So you guys can see now that many people in your class are actually, we are not clear about the concepts. You should have done these readings, okay, about the base asset and the terms asset. And you should be clear about all the asset classes. So first, you have to understand, in the currency markets, you can make out, it's very easy to make out from the notation, okay? So if you see, for instance, Aussie US, it will always be written as AUD USD. Okay, in this manner. Okay, it is written as, if you look at my if you look at the notes here, if you look at the notes here, that where have I put the notes in the three scenarios? Yeah, okay. The three scenarios. If you see, we're going to consider three different scenarios: Aussie US, okay, and dollar Swiss. Okay, so this is called Aussie in the currency market. This is just called Aussie. So if you say somebody tells you that I'm trading spot Aussie, you automatically understand that they are trading Aussie against the US dollar. They're not going to tell you that I'm trading Aussie US. I'm using that expression because I want to make it clear to you guys. Okay, but market convention is this just referred to as Aussie. Now this will be referred to as dollar Swiss, okay, in the currency markets, and this will be referred to as Aussie yen. So in the currency markets, it's very easy to figure out which is the base asset. It's always the one that is mentioned first. Okay, but this is a mechanical way of understanding it, almost like mugging it up. But you have to understand conceptually what is happening. Okay, so if you look at this now, the Aussie US, since I gave you the rule, the base asset in the currency market is the one that is mentioned first. Okay, but you have to understand it conceptually. Make sure you go through the readings and understand conceptually what is a base asset and what is a terms asset. Okay. So Aussie is the base asset here, dollar is the base asset here, and Aussie once again is the base asset here. Okay, so let's understand what it is. As Utsav correctly pointed out, this 0.7350 here means 1 Aussie is equal to 73.5 US cents. Okay, that's what it means. So it's called the base asset. Understand the concept here. It's called a base asset because it is like a base. You can think of a base as something which is like, you have a table lamp and then you have a base of a table lamp. So the base is kind of fixed and it doesn't change. It's kind of stable and fixed. So what is happening in this chart, if you can see, as the price is declining, okay, what is happening is at all these points on the chart, it is always the price of 1 Aussie. That part is not changing. Okay, 1 Australian dollar. It's always 1 Australian dollar. What is changing as the scale is changing? What is changing? What is changing is the number of US dollars. So when I say 1 Aussie is equal to 73.5 US cents, that also means that you can, in order to buy 1 Aussie, you will have to pay up 73.55 US cents. Okay, that's what it means. So now if I use this language to understand, now this is the concept of base asset and terms asset. So make sure you understand it clearly. I'm explaining it in the class. So in any market, the base asset is always the one which is, remember it easily by logic, as base means base of a table lamp. Base is fixed, it's not moving. So when you look at any chart, there's always, first you have to understand the concept of every market. A chart will be talking about chart of some market, a chart of some market. And a market is always a place for exchanging two assets. So there are always going to be two assets. And one of those, if you see the chart and you try to understand, one of those is always fixed. So here what is happening is, as it is going down overall, long-term downtrend here, what is happening is it's always the price of 1 Aussie. But what is happening is the number of US dollars required to buy 1 Aussie, that is what is fluctuating. 1 Aussie is never fluctuating. It's always 1 Aussie. It used to be here about 74 cents you required, 74 US cents to buy 1 Aussie at this point. But now we need much less, around 70.5 cents, okay, over here. Okay, but the 1 Aussie has never changed. So if you look at any chart, you'll have this kind of a relationship between the two assets. One of them will never change. That's the base asset, because base means kind of fixed. You can think of it that way. So in the currency markets, it'll be called base currency. Okay, and in general terms, we'll call it base asset. You can read your notes for all this terminology. Make sure your concepts are clear. Otherwise, you'll get confused in this modeling trade P&L discussion. Okay, so base asset is Aussie and terms asset is US dollar. Why is it called terms asset? Because 1 unit of Aussie is being priced in terms of US dollars. Okay, you see it in every market. When you go to the Indian market to trade sugar, 1 unit of sugar, now that may be a quintal, that may be a kilo, whatever the unit is, okay, that the market conventional will decide, it doesn't matter. 1 unit of sugar is being priced in terms of rupees, so that 1 quintal of sugar, as the market is fluctuating, the price keeps fluctuating, but that 1 quintal of sugar doesn't change. It's always 1 quintal of sugar, but the price changes. So today it is 40 rupees a quintal, then it might be 70 rupees a quintal, 90 rupees a quintal. So what is changing is the price in terms of rupee, how many rupees you need to buy 1 quintal of sugar, but the 1 quintal of sugar is never changing. Okay, so in any market you'll see this dynamic and try to figure it out. And the part which is never changing, the asset which is never changing, is the base asset. The other is the terms asset, because 1 quintal of sugar is being priced in terms of rupees. Here, one Aussie is being priced in terms of US dollars, like in the sense in terms of US dollars, which is to say that, like, how many US dollars do I need to buy 1 Aussie? Well, the answer in early September, the answer was around $74.74. But today, the answer is only around 70.5 cents, less than 71 cents. Okay, but it's always one. So this is basically what it is. Okay, so once conceptually you understand this, then you have an easy notation in the currency markets. The base asset is always mentioned first. Okay, so now this is, once you have understood, this is very important to understand. Okay, now we'll see what happens. So we will see more, because we initially looked at this. For our stock trading scenario, this kind of formula is good enough. I can write the position like this. Okay, position size should be equal to PNL divided by, so when the PNL here, okay, in the stock trading formula, that will essentially, this will be the maximum risk per trade, okay, which we'll put it here. If that will be our figure, okay, and that will tell us how much position. So in this case, in the case of stock trading, to help you with your current project, you can just write a formula for this and do it this way instead of doing trial and error. But now we have to learn the theory, so we have to learn in more general terms, okay, where what we are going to consider is we are going to consider three. Okay, so I'll stop it here because we're just going to enter this module. Okay, so these scenarios. So we'll continue in the next class. We will look at the more general situations where you can have all kinds of complications based on the relationship between the risk capital currency and the where the trader. Another thing you should always understand is the PNL is always generated in the terms asset. Okay, we'll do this term, but you can think of it once again. Once again, think of the simple things that you already know. I'll release you in one minute. I'll just mention this principle. That this is a general principle, always true, okay? It's always generated in the terms asset, because by convention, we trade in the base asset. Now, if you trade in the terms asset term quantities, it will be different, but that's a very unusual situation, because this is always, trading is always in the base asset, okay? In units of the base asset. We'll write that later. So if you trade, remember this, if you trade sugar in India, okay, if you say today you have traded 600 quintals of sugar, let's say you're a wholesale trader, you've traded 600 quintals of sugar, all the money you have made, that money is not counted in sugar, that money is counted in rupees. Okay, so you're trading sugar against Indian rupees, and the rupee is the terms asset, sugar is the base asset. So your PNL is always in the terms asset. This is true in every situation, okay? Because trading is in terms of the base asset. Okay? So since by default trading is in units of base asset. Okay. All right. Okay, you guys can go now. If anybody has a question, they can stay, and we'll continue with this in the next class. So class is dismissed. You can go. Anybody has any question? So PNL is always generated in the terms as if this is an important principle, since by default trading is in units of the base asset. So when you trade sugar, you are trading in quintals of sugar. You don't trade sugar in terms of I want to buy sugar for 10 million rupees. You can also do that, no bar on it, but that's very unusual. Okay, so the general by default, the assumption is that trading is in units of the base asset. All right. So if you have no questions, then we'll end the discussion. Is that okay?
Okay, sir. Thank you, sir.
All right. Okay. Okay.
Thank you, sir.
Thank you, sir.
All right. Okay.